Ladies and gentlemen, welcome to this panel session on foundations, asset management, performance, and benchmarking. I'm Tony Barada. I'm a professor of finance at the University of Geneva, and I have the pleasure of being the moderator for this session. We will have a short presentation on the main result of the benchmark report prepared by PPC Metrics that will be presented by one of the panel participants. And then we will have a panel session to share insight by expert on various areas regarding this report. Let me first introduce our panelists for today. First of all, from PPC Metrics, Cyril Berner will give you the results of the report. Cyril is a managing consultant at PPC Metrics since 2009. He has previously worked in global custody and quantitative asset management at Lombard-Odier, and he holds certificates in international business, quantitative asset management, and international investment and analysis. Also an expert on oceanography, I just learned before the panel. So Cyril will have 10 minutes to present the reports. Following that, we will have a discussion with three experts from different areas. From the academic sector, we have Professor Raina Gibson-Brandon. Raina is a professor at the University of Geneva and the founder and deputy director of the Geneva Finance Research Institute. She's been a member of the board of directors of Swiss Re, BNP Paribas, and she's currently a member of the Bank Council for the Swiss National Bank and a member of the foundation board of the Geneva Institute for Wealth Management, and also the Swiss Sustainable Stock Exchange, SwissOx. I asked Raina to shorten a biography. There are a number of other things that should be added. And her research focuses on asset pricing, experimental finance, and sustainable finance. We have also Guillaume Taylor. Guillaume has worn many hats in finance, working in corporate treasury and credit, microfinance, traditional wealth management, but also private equity and venture capital impact investing. And he is today working on foundation capital investment and small-scale infrastructure asset management. And finally, we have Vincent Kaufmann, who's been the CEO of Ethos Foundation and Ethos Services since June 2015. Vincent joined Ethos in 2004. Since June 2018, he has been a member of the board of Swiss Sustainable Finance. He's a Swiss certified expert for accounting and controlling since 2009 and holds a master's degree in business economics from the University of Geneva. After the presentation, we will have the panel session, and we will try to keep some time for a Q&A at the very end of the session. I will ask you to hold all your questions up to that time at the very end of the panel. And just before we start, I'd like to remind you that this event is co-sponsored by Swiss Foundation, who commissioned this study, and represented by Aline, who's sitting right there. And also co-sponsored by the Geneva Center for Philanthropy at the University of Geneva, represented by its executive director, Mara Desmonté, who's sitting right next to Aline. They have tons of other very interesting activities. Feel free to go and talk to them at the end of the panel, and maybe take a copy of the report that is just right there if you're interested. Cyril, let's get started with the presentation. You have around 10 minutes, and we are eager to hear what you have to say about benchmarking and performance of foundation in Switzerland.
Good afternoon, ladies and gentlemen. First, before starting my presentation, I'd like to thank you, the Geneva Center for Philanthropy, as well as Swiss Foundation, for the organization of this event, as well as for giving me the opportunity to present the 2023 benchmark report. What is the benchmark report? It's a benchmark which has been created 7 years ago and who is issued every year, and with the purpose of presenting how the foundation invests their assets, and also it takes the opportunity for the foundation to compare themselves with their peers. The benchmark report is composed of 46 foundations for a total of 10.1 billion. The smallest foundation is of 4.3 million. The benchmark is split between small foundation, which have less than 10 million assets, medium foundation, and large foundation, which have assets of minimum 50 million. Oops. Now I start with the presentation of the benchmark. The first part is the asset allocation. The asset allocation for foundation will be the base of the return and the risk the foundation is ready to take. So what we can see on this slide is that the allocation is well diversified. So on average, most of the foundation diversified their investment between cash, bonds, equities, real estate, and alternative investment. One interesting thing is to see that the level of cash is of an average 9%, which is quite small, which means that the foundation trusts in financial market and they think they can earn more than leaving the amount in cash. Second point is the equity allocation and alternative. Equity allocation is the largest allocation of the largest asset class, which has 41% on average, and alternative investment have more or less 10% on average. Why did I talk about these two asset classes? It's because on the next slide, where I will talk about performances, I can define the risk of the portfolio with equities and alternatives. Now, what are the performance of 2022? As most of you know, the performance of 2022 were very negative. On this graph, we see on the left axis, you have the return done by the foundation, and on the bottom axis, you have the proportion of equity and alternative investment. What we see is 4 foundations got a positive performance. So on the top, you have the 19, the 35, the 34, and the 26, which have realized a positive performance. This is explained because they had mainly real estate, direct real estate, which performed positively, and the two on the right have some alternative investments which perform positively. But you see that most of them perform between -10 to -15%. And this, whatever the equity and alternative allocation. A foundation having 30% of equity or 70% of equity, performance is exactly the same. Why? Because the bonds were also negative. So during this year, the diversification didn't work, and whatever the asset class you were, you couldn't save your portfolio. But hopefully, this is not the main, the normal year, and normally the diversification should pay. In order to show you that, I go to the next slide. No. The next slide, where I took 2 years. 2000, so it's also coming from the benchmark report, 2018 and 2021. Why 2018? It was also a negative year. But what you see is that the more the foundation were on the right, so the more equity they have, the less performance they got. So in that case, having less equities brought you a better return than having more equities. The opposite is also true. If you take the 2021 year, the average performance was of 11.8%. In that case, the more equity you got, you have, the more return you got. So these 2 years are normal years. So my message is just to say 2022 was really negative, but it's not the normality. 2022 also a short graph on the illiquidity. Illiquidity saved the portfolio. I mean by illiquid assets, direct real estate, private equity, infrastructure, and so on. So foundation who had this sort of asset classes saved a part of their portfolio. We find again on the right top the 19 and the 35 where they have a good positive performance due to the illiquidity. To finish the part of the performance on a positive way is if you look at the red lines is the performance realized by the foundation from 2018 to 2022. So during these 5 years, we have the performance of 2022. And what we see is, on average, the performances of the foundation were positive, 8%, versus more or less 0 for cash. So what I told in the beginning is correct. The fact to invest in the financial market brought a good performance to the foundation. And on the bottom side, you have 2000 gray, you have 2022, where we see that whatever the level of equity, the performance were almost the same. Sustainability and finance. It's a heart of building bridges. My question is, are the foundation sensitive to this theme? Looking at the statistics, yes, they are. 85% of the foundation invest in have sustainable investment in their portfolio. But still 15 haven't. Their main reason for them not to have sustainable investment in their portfolio is they are currently planning to do it, they are not yet concerned with, or some things it's quite complex to implement in the portfolio. Next slide. Here you go. What are the criteria used for the 85% of the foundation which include sustainability? 97% are negative criteria. Best in class, 74%. So 74% of the foundation includes best in class investment. And finally, impact investing, 44%. I talk about impact investing because it will be a subject which will be talked with the panel later on. What we see also is the level of sustainability increased during the year. In 2021, 95% of the foundation had negative criteria versus 97 now, and best in class moved from 65 to 74%. What I also have to say is looking of the 7 years of the benchmark report, in 2017, 50% of the foundation were including sustainability. Now we are at 85%. So it's a trend which increased during these last 7 years, and probably it will increase, and the 15% which are left will probably also come with sustainable investment. Last slide, and quite interesting one, is, as I told you, 85% of the foundation have sustainable investments. Now we see on this slide that 43% do not consider sustainability when they are selecting a manager. And the same with reporting. 43% don't receive an ESG or sustainable report from the asset manager. So quite interesting to see the difference between the level of sustainability and if what they do when they select a manager. I thank you for your attention, and now I leave the floor to the panel to discuss all these items.
Thank you very much, Cyril, for this presentation. So the benchmark that is proposed in this report is a portfolio. It's a way to compare your performance as a foundation to your peers, and your peers are defined as some average over the asset allocation chosen by respective foundation. And foundations are special investors. It's not entirely clear that they want to benchmark themselves against a portfolio that is the average of what the others are doing. So this, to me, raises the question of what actually is the appropriate benchmark for the performance of a foundation. And this is the first question I would like to ask the panel, and we will start with Raina.
Yeah, so thank you for giving me this opportunity. I'm going to speak a little bit from my academic understanding of asset pricing and asset allocation as I teach this. But also I was a board member of Swiss Re for 18 years, where I was also part of the investment committee. And it's also a large institutional investor, which is a long-term investor. So to me, actually, a proper benchmark is taking a selection of passive indices, investable indices, and combining them in the same way as the foundation or the investor would have had an asset allocation. So in some sense, it's quite simple. The problem that might arise for the foundations is that they might have statutory constraints for the cash flow, so that might be a little bit difficult. But I think if you have an asset composition, if you have an asset allocation, and today we have many investable indices, it should be quite simple to have a proper benchmark by just applying this composition.
So clearly from your perspective, the benchmark is a portfolio, it's an investable portfolio, and we should be looking at performance in terms of financial metrics. Guillaume, do you share that idea?
Well, at Montagu, we decided to go for more of a tailor-made approach. And that tailor-made approach tries to look at, in any benchmarking we do, our mission, our philanthropic activities, and our capital. And so we try to look at the landscape. What is our landscape? Integrating both elements, both verticals. And how do we manage the output versus the outcome? A performance is an output, but what outcome does it have on our philanthropic portfolio beyond just simply financing the philanthropic activities?
So in a sense, sorry to interrupt, but in a sense, it's the distinction between a financial metric and something a bit more humane in the sense that we could measure from that performance metric?
Yeah, I mean, if we're talking about responsible investing, we're all talking about the same outcome as philanthropy. There's no difference. The means are a little bit different. Some of the specializations may be a little different, but everybody here is looking for the same outcome. So at one point in time, you can no longer separate the tools to get to that outcome when you're measuring your outcome and when you're benchmarking, because then if you're just looking at financial benchmarks, you're missing out on that outcome, which is that impact that you want.
We'll come back to that point on impact investing, but Raina already wants to reply.
If I can just complement, what I was talking about was for the financial performance. Of course, you can also benchmark the ESG performance of the equity portfolio, the bond portfolio, and the alternative investments portfolio, but I think this is the subject you wanted to tackle maybe later on. So
sure. Obviously, choosing the right benchmark is a complicated question. And my point was to see whether a portfolio is sufficient to fulfill that task of providing a reference point. And Vincent, what is your view on that?
So selecting the right benchmark for the foundation, I think it's an important duty of the foundation board. It has to be defined based on the risk appetite of the foundation, and typically the cash flow need and the philanthropy need, what impact the foundation board wants to strive with the investment. So I guess in selecting the asset allocation is clear, it's more on the risk appetite, and in then selecting the right instrument, I think that's where sustainability criteria have to be introduced, and I think that's where mission-related investment should come into force. So then it's still worth benchmarking the performance against normal benchmark. I don't see any reason why we should not compare that to traditional benchmark. But I think here the role of the foundation board is key. But when I see the result, I think it's quite similar to what we see in pension funds. So also there is not the same fiduciary duties toward beneficiaries. There is still the same approach which applies, which I find quite interesting.
Thank you. Looking at the historical performance, when we saw the three graphs, 2018, 22, and third one, I don't remember, we had quite a bit of variability. I mean, what you see from that is apparently that foundations are taking risk with their endowed capital. And the next question relates to that. So foundation take risk in their investment, should they? And let me start with you, Guillaume.
Yeah, absolutely. I think they should take risks. But where it's important, I think, afterwards is to manage risks. And for each of us to define our risk, because what is very risky for one is not necessarily very risky for the other. So risk is not a formula. Risk is a perception of what we can get to and what it could be the risks of getting to that and the cost of getting to that. So what we're trying to do at Montagu is really define the parameters of risk, what they mean, and the more you solidify those parameters, the more risk you can take and the more calculated risk. But I'm always coming back at the same term, as long as you know how those risks create an outcome. Never lose sight of that outcome.
Vincent, do you wish to bring your expertise on risk management to that question? So foundations are taking risk, too much, too little?
No, I think it depends, of course, of the goal of the foundation. Again, there is no one size fits all, because there are as many different foundations as there are. I think there are more than 3,000 foundation students, so not a lot have a lot of capital to invest. But if a foundation has capital, I think it's part of the fiduciary duties of the foundation board to invest that. You cannot afford to avoid the good years. So I think it is part of their role. So how far risk they have to take, again, it depends on the situation. If you go to LPP 60% of equities, 30% of equity, what part of real estate, as we know, it's less risky. So I think they should go for a balanced approach, because it's still, the capital has to be, the goal of the foundation is not to invest. I mean, it's to the philanthropy rules. So that's the key mission. But to support that, I think, it has to go with risk-taking and investment,
But from what I hear from Guillaume initially, it seems that there are financial risk and there is the risk of not reaching your outcomes, right? So, Raina, what do you think? What is the proper risk to look at, and is there a way to measure that risk of not reaching the outcome?
So I think, as any institutional investor, foundations, as there's different foundations with different mission statements, different sizes, different capital constraints, I think there should be first a clear statement about what the risk appetite is. Because of course, if you want to generate returns, even if you're doing sustainable finance, you need to take some risks. But the risks should be comprehensively coherent with the risk appetite. They should be coherent with the legal and statutory duties that you have, the horizon. What bothers me a little bit with these studies is that we see very short-term outcomes. As a long-term investor, so for instance, taking equity, we said, yes, they performed very poorly in 2022 because equities went down. But this is not a one-year myopic investor, this is a long-term investor, and we know that for long-term investors, equity or even illiquid assets are the right way to go. So I think clearly the horizon dimension is important to capture risk. So I would say the risk appetite and linking risk to the horizon are maybe the two things that I would sort of want to highlight for an institutional long-term investor as a foundation.
So the horizon that is considered in the report might be a little bit too short?
Short in my view, yes. Specifically, if you look at annual outcomes, the other one that was on the 5-year horizon, I think is more meaningful, and there we see that, you know, even though you're heavily invested in equity, some years you're going to do well, some years less well, but equity returns are mean reverting, so over the long run, these investments are less risky than they are perceived.
Thank you. One section of the report looks at sustainability and how these sustainability criteria are integrated and how they impact the asset allocation. I saw a very large bar for removing assets, the negative constraints. How do foundations in general integrate the various dimensions of sustainability? You both are on board of foundation, Rainer and Guillaume. So Guillaume, what are the criteria that you would be looking at in that dimension?
Yeah, this is a good question because right now we're looking at sustainability from investments, and there's a lot of pressure on financial investors to take certain data, standardize them, ESG norms, the European directives on impact investing and a taxonomy and so forth. But as a foundation, and I may be a little bit arrogant here, but sustainability and the issues on the ground, the hotspots, and what the solutions are on the ground with our philanthropic portfolio, I arrogantly say that maybe we understand sustainability beyond what the authorities are imposing on the financial industry. So for us, sustainability has to integrate our understanding and the parameters that we have put in place in our philanthropic portfolio, and not only look at the financial sustainability standards that are being imposed. So I would say we make up our own standards and we integrate that into the sustainability. So taking the learnings and the understanding of philanthropy and bringing them into the financial portfolio.
So it's rather subjective.
It is subjective, of course, I think, yeah.
And Rainer, I know about a recent study that you've conducted on how a pension fund integrates sustainability. So is it also very subjective, or do they have more precise criteria?
So maybe it's not about pension funds. We did a study with Philippe Kruger, which is called The Role of Institutional Investors as Responsible Investors. So we looked at actually 4,000 institutional investors, among them endowments, which are very close to foundations, and they all signed the PRIs. And I think I just want to highlight a few numbers which show the differences between what we found in this study and what you show us here for the Swiss Foundation. So one thing that came very strikingly is that Swiss Foundation used 97% of negative screening and 74% of positive screening, best-in-class approaches. In our study, for 4,000 PRI members that represent more than $1.2 trillion, the numbers are much lower, so 68% in terms of negative screening and 38% in terms of positive screening. Now, another big difference with that reference group, which is a large international group, is about shareholder engagement. So most of the PRI signatories, 82% use engagement strategies. Swiss Foundations seem to use much less. The number is 23%. But there's one number where Swiss Foundation do much better in terms of, and it's aligned with their mission, which is impact investing. So 44% here in this study are doing impact investing. In the PRI space, it's really negligible. So too much screening, and screening is very debatable in terms of the financial performance and also from an economic perspective. In fact, if you're doing negative screening, you're removing the bad assets, but somebody has to hold these assets. So you're making yourself a good conscience, but in the end, it doesn't make the world a better place. So I'm a bit not a skeptic about negative screening. But I think where maybe more could be done, and maybe Vincent can talk about that, is about shareholder engagement. And the third part where I think other institutional investors can learn from foundations is impact investing.
Yeah, maybe on impact investing, this is also the same conclusion if you look at the Swiss Sustainable Finance Survey published in June among Swiss investors. Impact investing is quite low. It's the lowest ranked investment strategies, and engagement and exercising voting right, active ownership goes much higher. I think it's a good sign from foundation because they should, I think, promote those kind of impact investment. They have less maybe constraint, regulatory constraint than a pension fund to implement such I would say more tracking error compared to traditional benchmark in their investment and being more related to their mission. So that's a good news. I could expect a little bit more in the future of this impact investment. It's also a question of definition. Hopefully we use the same definition. I don't know what they consider as impact investment because, as you know, that's still quite not well defined. And on exclusion, I agree, it's have less impact, but I think it's still important for a foundation which typically, I don't know, promote peace, not to invest in weapons. This is mission-related investment. You have to be coherent with your mission. So it's not about changing the world, it's about being coherent. And so I also think it's natural to see more exclusion from foundation. Again, they can afford more tracking error to be more aligned with their mission. And on engagement, I guess they do less because they are maybe smaller investor and they delegate to banks their investment. And maybe they don't have the voting rights because they don't invest directly. They invest via investment fund and certainly they have less, and we have seen the smaller foundation don't have any people internally, so maybe it's more costly and difficult for them to implement active ownership strategies. But it's possible, of course, and I think it's impactful as well.
Yeah, what we can see is regarding the size of the foundation, the small one delegate everything. The larger one have some people who are managing the investment and follow them. That's the main difference, as you said. Small foundation don't have the, I would say that, the resources to have a special finance specialist.
So Cyril, when you ask these questions to these foundations, do you find that foundation have a partner in the finance industry that provides instrument that allows them to actually implement their mission? Do they have something available? Are there instruments missing in the finance industry specifically tailored for foundations?
It's basically a discussion between the foundation and the partners, usually banks. For a question of cost, they usually take the funds which are available. We can do a special, as we say, a special mandate with special exclusion or special sustainable investment. Problem, it costs quite a lot. And foundation, they look also at the cost.
So coming back to your point earlier of having a tailor-made structure or a very specified portfolio, is this something that is only available to large foundations? And if so, isn't it a bit of a shame?
I don't think so. I don't think the size really matters. It's the attention that the foundation board is giving to these issues. And what is the responsibility that they're taking on? So I don't believe a complete delegation is the right way because we only have a small amount to invest. I think we have to understand that any decision that we as a foundation board take on the investment capital has an impact, no matter how small. So we can allow ourselves as a board to look at these financing issues and for them to be finance issues and for them to be part of the regular board meetings of the foundation.
So you all mentioned impact investing when we were talking about sustainability. This was one of the elements asked in the survey. Just before we move to that point, how do you define impact investing, Cyril, when you ask the question to the foundation? Do you define it, or do you assume that everybody knows what it is?
No, it was just ask if they do impact investing. So every foundation traduced it as they want. We didn't went further what's behind.
So that would be my next question, of course. So how do we measure impact when we follow impact investing strategy? I mean, what is the correct measure? We can start with you again, Guillaume.
I think from my time in the finance world, impact measurement was a lot about quantitative numbers. They're easy to measure and they're easy to calculate. On the philanthropic side, we're looking much more at qualitative aspects, less pure quantitative aspects. And there was this phrase that comes from Einstein or Benjamin Franklin, I'm not sure, but it says that what counts cannot always be counted, and what can be counted doesn't always count. And that's an important factor. So how do we bring in the qualitative aspects in our impact measurement? Difficult to do, but we can have a lot of learning from the philanthropic side that understands these qualitative measures, and they can help us, or we can help ourselves in bringing that into the impact measurement of our financial portfolio.
Rainer, how would we measure impact? Do you have a formula that you could share with us?
No, I don't have the exact formula. Actually, it was a topic of one of the sessions we had this morning, which was about proposing what we called relevant impact metrics. So it's not only about foundation, but it's about any investor who does impact investing, and mostly the DFIs. And there I tend to disagree a little bit, but I think it's good to have some disagreement on a panel. So what we were trying is to come up with a set of criteria that foster comparability and among projects and among investors. Because what we realized in doing this study, and this is actually joint work with the IFC, which is the DFI of the World Bank, is that most investors tend to use different metrics, academics tend to use different metrics, and there's no synergies or no homogeneity between them. That's the first thing. So what we did is we took one sector, which is the credit finance sector. Why the credit finance sector? Because that's where most of the investment projects seem to flow. And we realized that we had 5 criteria to make a good metric. Measurability was one of them, where I disagree with you. Good data was another one. Intentionality, so you have to be clear about the intentions behind the metrics. Incrementality, which means that you have to discount for the organic growth. And finally, comparability. You want to be able to compare across foundations also, whether one foundation is achieving its impact and the other one maybe is not. And what we came up with, which was really very surprising to us and to the other members of the panel, is that most impact investors, and these are the large impact investors, do really good at impact reporting. So they pass the bar of all the 3 first criteria that are good for impact reporting. When it comes to impact performance measurement, which need all the 5 criteria to be fulfilled, nobody passes the bar, no metrics. So what we recommend is, well, first you can say this is too academic and maybe there's no metrics there. And what we showed in the room this morning is that you can start with existing metrics, you can change them a little bit, and allow for comparability among metrics and investors. So I think, yes, a formula is possible, and actually we can do it.
But maybe foundations do not have to convince anyone that they're actually achieving, they're a special type of capital, right? Because, and I'll come back to you, Vincent, in just a second, but do you think that, well, they report to the board, but aside from that, it's very different from a usual investor who has to report on a metric to the general public. What about a foundation?
I mean, I think the objective in all of this is to bridge a gap, or maybe there's not much of a gap, but bring the philanthropic portfolio that is in the end a financial portfolio with the investment portfolio. And right now they're siloed. And so we can have all those matrix for an investment portfolio if we're measuring that investment portfolio to other investment portfolios and so forth. But that's not our goal. Our goal is to achieve an impact, a measurable impact, an outcome that's socially and environmentally related. That's the real substance. And so I think we can bring leverage if we marry the two and merge those skill sets. So I don't personally know how we can standardize measurements, because they leave no room for exceptions, and there are exceptions absolutely everywhere. And so nothing is tailor-made anymore, and that's a danger for me.
Vincent?
Yeah, I think it depends on which asset class you're talking about, because typically the availability of data, if you look at the listed equity world, now become more available. It's still not the best quality, but now, I mean, with the EU taxonomy, you can still find companies which have good disclosure in terms of what kind of product they bring to the market. Does it solve some things? And then you can start measuring actually the investee companies, what are their impact on the real world. And if you, back then in the primary market, so real asset world, then of course you have less data, but you have more impact because you give the financial flow to project, to infrastructure, to real estate, and that's where you have the more impact. But that's certainly where it's more difficult to measure. So academically, maybe it would be interesting to see measurement of impact and real impact might be contradictory somehow due to availability of data. So there is still a lot to do. And my analysts are reading all those annual reports of company. It's improving, and we can start measuring progress from investee company, which is good. But at the end of the day, that's the real economy which matters. That's where I think for listed equities typically, and you talked about active engagement, active ownership is also a way to have an impact on the portfolio. So not easy to define. I think intentionality of investors to have an impact is very important, the basis, to select companies which really are aligned with what you want to achieve at the end of the day.
And still in terms of impact, but more generally, Foundation have a lot of experience. They have a much longer history in being concerned about their impact on the outcome you mentioned earlier, and that was also mentioned here. Do you think that the finance industry, the finance world in general, has something to learn from the way Foundation are measuring impact or are choosing their asset allocation? Could it be that actually Foundation have something to teach the finance industry?
Yeah, absolutely, and that's what I was saying before about these qualitative aspects. And we have pushed the qualitative aspects aside because they're not easy to measure. So CO2 emission, 2 degrees, those are easy calculations. But when you look at the qualitative aspects, it's very difficult. But they have to be there because the impact may come only from qualitative aspects. We can decrease CO2, but are we destroying an ecosystem by doing that? Are we destroying biodiversity? So we're trying to measure biodiversity. So we have to integrate those qualitative aspects, and it's still work in progress with foundations. But that's why I think the people who are on the ground, on the philanthropic side, should communicate with the financiers. Why do they have to be separate? And should they work together and collaborate in building the portfolio of the foundation? I think yes, of course. It's the same skill sets in the end.
Right now, on that topic, should we go all qualitative?
As a finance person, of course, I have a mitigated view of this. No, I think that it's true that the sustainable finance community can learn a lot from the philanthropic, more than centuries engagement in impact and fostering impact. I don't neglect the qualitative side, but in the end, if we want to analyze impact, and that was the discussion of this morning, there were some DFIs there. I think for foundation, it makes sense as well to, at the end of the day, say, what impact have we achieved? Could we have done better? If you want to ask these type of questions, you need some robust metrics to do that, and I would defend a quantitative view of that, yes.
Thank you. And Vincent, in your experience, do you think as a partner in defining an allocation and defining an investment strategy, a foundation has something particular to bring to the table?
Yeah, I guess, but I would be careful because in some aspect of foundation activities, if I think about, I don't know, peace building or things like this, it's maybe less relevant for the financial industry. But of course, if the goal of a foundation is on biodiversity, environment, then of course, all the knowledge which are built on the philanthropy side or supporting renaturation or whatever, this could be very useful. Typically now with the discussion of the TNFD, and we're struggling to find good metrics, and certainly here there is knowledge which can be bring to the financial community or human rights or those kind of topics. So maybe it does not apply to all measurement. I think we should go more quantitative if we go to the financial world, because we have huge portfolio. I mean, we cannot just have qualitative assessment, which might be the case for philanthropy activities. Of course, you assess that certainly more on a qualitative basis, but on a portfolio level, you need some metrics, quantitative metrics. This is key. Yeah.
So Guillaume, are you convinced that qualitative aspects are just quantitative in the making?
No, I mean, I don't agree. Again, you know, philanthropy is a financial mechanism. We are allocating money to create an impact. So we have KPIs, we have ways of measuring, we have structure, we're supporting foundations that have governance, that have everything that a company has. The only thing that differs really is that bottom line. But the outcome that we're trying to achieve is exactly the same. So I think we should measure impact exactly the same way. For me, because if we keep separating finance from the groundwork, the grassroots work, I think we're not going to go as quickly as we should go in solving the issues. This is, for me, the first time in history that everybody has the same outcome objective in reality. So let's work together and yeah. So yeah, that's my opinion. Then to do it is much harder, of course. How do you get the person from philanthropy to understand the financial side and vice versa? So it's a nice to have, but I know to get there demands work. But I think we should, if we can bridge the two, then we multiply by 2 the amount of assets, financial assets that we have to solve the problem.
Vincent, you wanted to react?
Yeah. In an ideal world, but I think that would require a systemic change, because at the end of the day, if you look at financial market, of course we all want that those financial markets be long-term, aligned with the stakeholder values, but that's not the reality. We're focusing on quarterly profit, on daily profit. When you look at a company like Nestlé, the investment in the sustainability program up to 2025 is 3 billion, and even they are very, very proud to say we will spend less because we go further. And on one given year, they just made 20 billion buyback. So just compare 3 billion for the sustainability program, 20 billion to buy back shares to destroy them. This is destruction of value. For a lot of shareholders, they will, no, this is increasing my share price on this year, but at the end of the day, this is just cosmetic. So yes, of course, that should converge, but that's not the reality. That's not the world in which we're living.
So not to move too far away from the subject of the panel, the question was more about this idea that maybe these impact metric could benefit from expertise from the philanthropic world. And to come back to this, do you think that there are things in the way foundation address those issues and have been addressing these issues for, as you were mentioning before, right now, a long time? Are there skills that could be transferred from philanthropy because the financial industry is sitting now with a new problem. How do we measure impact? But these foundations have been measuring impact for decades, if not hundreds of years. So is there something to be learned there? This was more my question. And
So I would say, and I don't want to be controversial here, but
please. That's why they're all here.
Is this a tick-the-box exercise? So again, the authorities' standards tell us this is a taxonomy, and you just tick the box exercise, and we can do that very well. The person on the philanthropic side is going to understand in a very granular way what sustainability means. He understands the solutions on the ground, and so I think it's easy for us to say, okay, I have capital, and I'm going to go from investing in fossil fuel to investing in renewable energy to invest from junk food into organic food. But if you keep the same mindset, the same frame of reference as you did in the old investment world, we're not going to be able to do it. So I think we need to understand the real sustainability issues, and that demands work. Personally, you need to really figure this out, what it means. And it is very subjective, sustainability. And it's, for me, not a formula. So that demands work, but that's a challenge because then it doubles your cost as a financier to do your work. If you have to understand really in a deep way the fundamentals of sustainability. And that's the challenge for impact companies who are doubling their cost. They have to measure impact, they have to understand it really well. But they also have to deal with the financing, the financial elements that clients right now don't want to pay more for impact investing. So yeah.
I promised a few minutes at the end for a question from the audience. So unless you have something to add to that question and issue of impact, measuring impact.
I just wanted to make some marketing for education and academia. I think there's now been more than 10 or 15 years of research in sustainable finance. And I think from what we learned in the panel we had this morning is that there is a benefit for practitioners to work closer with academia. There are some ways that you can understand sustainability, that you can identify greenwashing, for instance, that has been documented. Among the PRI, we can tell who are the greenwashers, who are not. So there's a lot of important questions where academics do seem to have a response, but I think, in my view, the two communities don't interact enough to have a real debate about these issues. So that was just...
Thank you. Should we take a few questions from the floor? So if we could have maybe microphone moved. Many questions, so... Okay,
Hi.
let's start here.
Hi, my name is Firoz Adak. I'm the president of the Airfield Foundation, which is a network of private philanthropic families from the frontier markets. We don't like to use the word Global South. One comment, one question. The comment is that I think we should, in the global discourse, be aware of the fact that maybe here we are somewhat thinking still in a silo when it comes to foundation investment. I rely on my 15-year experience as a CEO of Rothschild Foundations, where, for instance, I came across many American families, extremely generous, of course, with pockets that are much deeper than in Europe, that would see no problem in actually investing in the tobacco industry because it had high returns, and say, well, the more money we make, the more we'll be able to dedicate to our programs. So this mindset, I think, to use your experiences, your reference is actually now starting to fade away, because I think there is a sort of a global approach to become a bit more coherent. But I think we should be aware of the fact that there's a big foundation world out there, especially in the US, where that mindset is still not totally aligned with the whole idea of mission alignment. That's one. And two, Guillaume, to your point, yes, by all means, I think there should be a more dialogue between the operational teams and the financial teams. You have to be aware, though, again, based on my own experience, that these are very specific skills. I would not necessarily expect my operational team to have the same skills as the finance people. And we've seen that in the market. When I was dealing with I basically migrated the entire Rothschild portfolio in the foundation to sustainability, dealing with bankers and seeing the immense progress which has actually been operated over the last 10 years, it's pretty impressive. And that's due to the likes of academic research, the pressure from the market, the pressure from the clients like myself. So I think there's scope for hope. The challenge I see in this argument of outputs and outcomes, as you were saying, is that if you only invest into areas where you feel your foundation has an expertise, let's say medical research or agriculture, then you have an issue of risk. Because then you basically put in danger the entire portfolio because you actually heavily concentrated. How do you tackle this?
Thank you. The question is, concentrated portfolio, good, bad?
Yeah, obviously the program-related investing that I was referring to, you can't do it for the whole portfolio. But in terms of the skill set, first of all, it's allowing you to be aware of that outcome at all times for any investment decision, whether just never lose sight of that when you do investments, and then it's a step by step, and then you decide that you've done enough program-related investing. After 20% of your portfolio, you stop, and that's your decision in terms of risk. But coming back to the skill set, and it's a very good point, Firoz. Right now, we're asking financiers whose skill set was, let's say, 100% on the traditional investment parameters. We're asking them to add a skill set, which is the social and environmental, understanding of the social and environmental elements. And that they need to be they need to integrate that into the skill set so it doesn't become a simply tick the box exercise. The European authorities on responsible investing have a taxonomy of 200 points, and I just tick the box. But you know that better than anybody, that tick-the-box exercise is dangerous. So we need to develop the skill sets as financiers, but the philanthropists, I think, need to develop a skill set on the investment side, so it's a balance. It's no longer 100%, it's maybe 30, 70, and that takes time, and that takes effort, and that takes education. It takes looking at academia. So that is a challenge, and so it's work in progress.
One question if it takes less than 10 seconds.
Yeah, in addition to this, the difficulty of definition of impact finance, there is also a question of packaging, because it's sometimes difficult to invest in impact finance because it's not, packaged for pension funds or for foundations, because it's difficult to assess how much risk, how much return it gives to the portfolio. Is that also a problem of how to invest in this?
Understanding the characteristic of impact investing in terms of their financial risk-return trade-offs, is that the question? So that would be the last point of the panel because we're almost out of time. So do you think that the instruments provided for impact investing are sufficiently clear to be integrated in a portfolio?
Yeah, I would say there are some strategy. If you look at the microfinance, real asset world, you can really have impact. You can measure impact. You can measure return, and of course, you still have to have a risk appetite and a differentiate portfolio. Of course, you cannot put all your eggs in the same basket. So, of course, you need to diversify that. Again, it comes back to the first question, risk appetite of the foundation, how far we go, and that the foundation board, and they have to be educated because they have to understand they have two missions. They have to invest and they have to make their philanthropy duties, and that has to be coherent.
I'll take this opportunity that you come back to the first question to wrap it up because we're coming to the end of this panel. So I want to thank you very much for your answers to all the questions we had today about the performance of foundations' assets. And thank you for being here again. Thank you, Cyril, for the presentation. You have copies of the report right here. Please have a copy. There are many other aspects that were not presented that you can find here. And I'm sorry we couldn't have more questions than the 2 we've had. The speakers are going to be around for a little bit of time. Feel free to come and talk to them and ask them their questions. Thank you again for all being here, and have a great few more days of building bridges.